Hi, everybody, and welcome to our today session with Rhett Shipp from Wave Financial. Welcome, Rhett.
Hey, thanks. Glad to be here.
It's great to have you here in these crazy times. So before we kind of dive into what we have planned, I think we need to touch on what happened. And I just want to grab your thoughts. What do you think about the events of yesterday?
Very sad, honestly. I was pretty surprised that FTX had some of the weaknesses that have been, displayed. I thought that they were rock solid and sitting on a mountain of cash, and I think most people thought that. Really sad for those hurt. And I think I tweeted about this yesterday. I think it is like a further demonstration of why DeFi is so advantageous over CeFi, because FTX, everyone's been sitting on this assumption for a long time that they are just printing money and they have they're completely safe in every way, but there's no real way to verify that until they get bank run, and then it manifests this weakness. And whereas in DeFi, you can just like look right now and see, okay, on Liquity, on Aave, who would get liquidated where? Are there any bad debts? Like, that right off the bat. And, even the exposure that like FTT had in DeFi was the easiest thing to track down. The moment that Binance started dumping FTT, our team looked at Wave and said, okay, what's our exposure to this in various positions we hold? And you can just go and see, here's where it's being used. And for obvious reasons, that's also what Alameda prioritized. Like, if you look at Abracadabra, they had a lot of FTT collateral, and Alameda just came in and paid all of that off. So it's super sad, but to me, it's another just demonstration of why DeFi is a better way forward, in my opinion.
Cool. And maybe last question on that. What is your takeaway for asset managers that are newer in the space out of these events?
Yeah, good question. I think so. One of the things that we've talked about a lot internally is one of the things that we do a lot of is manage stablecoin for yield, and we have relationships with centralized counterparties that we can lend to, and then we have opportunities to use these assets in DeFi. For a long time, we have only been playing in DeFi, and I think there's been this perception by outsiders that, well, DeFi is really risky, but if you lend to so-and-so, that's less risky. We've actually viewed it the opposite for a while now, and this is like another demonstration of that, which is that, if you have a decentralized platform, especially if it's also immutable, so your due diligence that you did 6 months ago is still relevant today, and with really solid mechanism design, etc., and who your counterparties are, and how liquidations will happen, and there's not some like hidden hole or whatever, it's really in a lot of ways the safer place to play. And so not just from a returns perspective, but even from a risk perspective, we've tended to favor DeFi over CeFi, like significantly. Like I said, we haven't, when the 3AC meltdown happened, we also had no CeFi exposure in those funds, and it was like it demonstrated how good of a choice that was. And this has like demonstrated it even more strongly, because FTX blowing up is so much more unexpected and so much bigger than Voyager, Celsius, etc., 3AC. And so so that's one of the things that I would say is that I think some people who are maybe newer to crypto have their logic inverted. They think that DeFi is inherently risky and that CeFi is kind of like the safer thing. And I think in a lot of cases that's inverted. Now that's with the asterisk that you need to do your due diligence on the DeFi stuff too, because okay, Mango Finance is a good example of like, you look at that protocol and it's very obvious very quickly that it has bad mechanism design. So you want to stay away from those. I'm talking high quality blue chip DeFi protocols, ideally that are immutable, and then also that don't accept like unfettered long tail crypto assets as collateral. That was Mango's big problem, right? Like that's such an obvious thing. It's such an obvious exploit that like it was. I think it was unethical of Avraham to exploit them, but it was obviously like really bad mechanism design where, at the very least, put a mint cap on your Mango since it's a long tail, easily manipulated asset price. You know. So anyway, that's kind of high level my thought on that.
Cool. Thanks on that. And then now maybe let's go back to our topic of today. So we really want to look at Liquity and Wave Financial and what you do with Liquity. So first, to give listeners a bit context, can you tell a bit more about you and Wave Financial, what your offerings and your clients are, so we understand a bit your business?
Yeah, absolutely. So we're a crypto asset manager, SEC registered, one of the few kind of in that more regulated part of the space. And we do a few things. Kind of the biggest part of our business is crypto native treasury management. Say you're some big L1 or application or whatever, you have a treasury, and say it's a mix of your own native token and some stable coins or whatever, and you have various business needs. We'll manage that as your fiduciary. So and there's various things you may need there. You might need to earn some yield on your stable coins. You might need to diversify your treasury or use your treasury productively, or, you know, and sometimes you can kind of serve multiple needs at once. You know, in the case of a layer one, maybe you have your treasury and your native token, and one of the things we can do is use that productively in DeFi in your own ecosystem, and you generate yield and also help facilitate the health and development of your ecosystem, right? So it's kind of dual purpose. So we do like a lot of those things for crypto native treasuries. We have a number of funds. One is a stablecoin yield fund, and we'll take LPs from, you know, crypto natives, both organizations, you know, DeFi teams that have some stables they need to earn some yield on. They don't want to manage it themselves, but also accredited investors, and then we have some LPs that are kind of traditional institutions that are wanting to play a little bit more in the crypto space, and a lot of them are wanting to enter in the stablecoin side. I think there's the perception a lot of people have that most institutions are entering through Bitcoin. My perception is there's probably some truth to that, obviously. I mean, Michael Saylor's company entered through Bitcoin, right? But a lot of companies are entering through stable coins. Like, hey, we just need to earn some better yield on some of these assets. So those are some of our clients. And then we also have, we manage assets for mostly like crypto whales. So, you know, accredited investors that have, say, you're sitting on a whole bunch of ETH, you want someone to custody it for you and then manage it, etc. And we have a number of those, like we call them wealth clients that, you know, yeah, we'll custody their assets and then engage in various strategies for them. Like maybe they want to generate yield on their ETH, and so we will develop a custom kind of strategy or framework for them, and then we'll generate yield on their ETH for them. Or maybe they just want to, you know, borrow against their ETH. You know, we'll talk about that a little bit here. And it's like, okay, you can, we can help you get better terms on borrowing than you could going to some centralized parties, et cetera. So yeah, so various things. So we're managing assets for crypto whales, for accredited investors, for crypto native treasuries, and then also some institutional investors, mostly on the stablecoin side. Okay,
cool. And your role at Wave Financials?
Yeah, so I'm on the DeFi team. So it's a small team, and it's I would call it both vertical and horizontal. So we will do DeFi things anywhere that's applicable on for any of our funds, and then we have some DeFi focused funds. We also have a few VC funds, and I will join the VC team anytime it is relevant to DeFi. So so if our VC team is talking about making an investment in a DeFi protocol, then I am part of that process. But if they're dealing with non-DeFi related stuff, then I'm I'm completely out of that loop. And then, yeah, we manage stablecoins and custom strategies. So it's kind of a vertical and horizontal role. And then we have kind of coming down the pipe, we'll have more DeFi focused funds over time. So right now, the main one is a stablecoin yield fund. We have a Bitcoin yield fund, but it's not DeFi. It's selling covered call options on to like, you know, OTC desks. But yield generating funds on other assets like Ethereum, et cetera, are things that we're looking at launching as well. And some of those are the most exciting to me. Like generating yield on stablecoins is great, but generating yield on ETH, I think, is super exciting. And so we're talking about expanding those offerings over time.
Cool. Thanks a lot. Yeah, so maybe let's have also a look on the Liquity side. So maybe there are some people that are not fully familiar with the Liquity side. And I think that's maybe a great opportunity that I don't explain what Liquity is in my own words, but maybe you could also tell the audience how you discovered Liquity and how you would describe it in your own words when you, for example, then explain it to your clients.
Yeah, good question. So how I discovered Liquity, well, background, before I was full-time in DeFi, I was working as a data scientist. I won't get into my back history, but have been deeply, deeply obsessed with DeFi since it's existed. Like, I remember before MakerDAO launched, getting super stoked about interviews with Rune Christensen and wondering if you know, decentralized collateralized stablecoin could even work. So I've been very you know, aware of developments as they've come. So clear back in the early days of Liquity, before it even launched, I was following it, super stoked about it at launch. And so I've followed your team and your product since before I was at Wave, honestly. And the way that I describe it to clients is that it is a super high quality, very low cost place to borrow against your ETH. High quality because it's immutable and because the mechanisms are super efficient. So you have really efficient quality mechanisms for maintaining the LUSD peg with redemptions, and then the stability pool for liquidations is very efficient. And then that comes with these other benefits too. That are I'll get into it in a bit, but it's a huge benefit to our clientele that you can allow a more aggressive loan to value or over collateralization ratio because of how efficient the system is. Our clients are not degens. No one's like borrowing right up to that level, but having that bigger buffer is an attractive thing. So that's the way I describe it. Very low cost, high quality, efficient place to borrow against your ETH.
Cool. And can you tell us more about the use cases? How, on a high level, we can then deep dive in each of them, but how you use it at the Wave Financial and how it would look like, you know, for like typical client, what their need is and what you then do with Liquity, so we get a bit more hands-on idea.
Sure, yeah. So I would say there's kind of four major ways. So one is a person just wants to borrow against their ETH. And we've had this happen with clients where a client that we're custodying some ETH for says, hey, I want to go, will you send my ETH back to me? I want to go borrow against it on BlockFi and buy a house. And literally, you know, one of the use cases, it was the first week I was at Wave, I was on a call where that was the exact conversation. And I was like, why would they send it to BlockFi? Let's look at DeFi options. And that was one of the easiest conversations I've ever had, which is we just had a call with the client and said, look, okay, on BlockFi, you'll pay 8%. And then, you know, in DeFi, here are your options. And it was like, you know, Liquity, Aave, Alchemix, and MakerDAO. And for that particular client and for many clients, Liquity turned out to be a really great option. And so for one, it's, hey, a person just wants utility on their ETH. They want to borrow against their ETH to buy something. And they're going to be holding that loan for a long time. You know, they'll pay it back over time. But it's like a, you know, crypto native, you know, low cost mortgage. So that's one use case. Another use case for a holder of ETH of ours is, hey, I want to earn some yield on my ETH. and then you have options, and we'll present a number of options, and then sometimes have a blended strategy. So one option is you stake your ETH in a liquid staking derivative. Okay, so another is you lend it, or you stake it and Liquity provide it. But a third option is you mint some LUSD against it on Liquity, and then you just either earn stable coin yield on that, or throw into the stability pool, and then you just manage the loan, the debt ratio, right? So if I can borrow on Liquity at 0 and I can farm, say, 10% on stables, and I left it all in stables, the risk, if you're managing it, is surprisingly attractive. Like, so even in the event that the market dumps, you can just pull back and pay down. And so that can be an attractive yield generating strategy for some clients. And it depends on clients, risk profiles, and then also, is someone wanting to earn ETH on ETH, or are they wanting to earn dollar yield? So these are some of the considerations. So that's another way that we can use Liquity. And then two other quick ones from the stablecoin side. If I have a client who has some stablecoins, and they say, hey, I want to just dollar cost average into ETH, an easy way to do that is to convert to LUSD, throw in the stability pool, and then, okay, if there's a bunch of liquidations, you just DCA at a discount, great. And then if there's not, and you say, okay, I've been sitting here for a month, I was paid for my time because I'm getting some LQTY, but I wanted to be DCAing faster than that, then you can, market buy with, you can market buy as you need to. If you're employing that strategy 6 months ago, you got some nice liquidations, but over the last few months, there have been fewer. So you can just, you say, well, while you're sitting on the stable, you earn some yield. If there's liquidations, great. And then if not, you can pull a little bit out and swap for ETH, so that it's a really attractive kind of DCA strategy for clients. And then the last one is for our stablecoin yield fund. LUSD is this very, very, very high quality stable. And so earning yield on LUSD is attractive. And there's a few places that we have done that. One is Liquity providing LUSD on DEXs, and then another is farming yield in the stability pool, kind of B protocol style, where if you have any liquidation rewards, you just roll it back into LUSD. So those are kind of I would say the 4 ways that we've used Liquity.
Cool. Great. Thanks for the overview. Maybe let's break it down and also explain it a bit to users that are not so deeply involved in the ecosystem. So the first one, I think, was the boring use case. And I think usually say you have clients, they go to BlockFi, they send their ETH, they pay the 8%, and they get the loan. On Liquity, it's similar, but it's the Liquity protocol. You take your ETH, you put it into Liquity, you can take up a loan of 90% in the LUSD stablecoin. You pay a one-off fee of 0.5%. So the loan has no maturity, and you can keep it as long as you want. And kind of you have the same effect. On one side, you have BlockFi that's centralized, where you have counterparty risk. On the other part, that's the DeFi option, where you don't have the counterparty risk, but the technical risk. So just to highlight that, and what I love about you, and when we talked about what you do at Wave Financial, is really that you have these client stories. That's a bit. I mean, we launched a protocol. It's immutable. It's running out there, but it's running on its own. So it's dealing with its clients on its own, and we don't have any contact. So that's what I love, and I would like to hear a bit these client stories, the client feedback, how they react, because that's something we are not so close to. So I would love to hear a bit kind of how people react or respond when you tell them that, and then also honestly a bit what you tell them. What are the pros? What are maybe the cons of the solution, or what do you need to be aware if you use Liquity? Well, what are the great advantages, but what do you also need to be aware of?
Sure. Yeah. So these are great questions, and I'll get into one specific story that I think will touch on a lot of this. So, solutions like BlockFi, I think, are interesting in that they're attractive to people who are in crypto but feel afraid of operating in the blockchain by themselves. You know, it can be pretty scary to have all this money in a wallet, and you don't know if you're going to get exploited and someone steals your private key and all of this. And look, I was a little bit, I remember when I first learned how to use MetaMask, I went over to a friend's house and he was like helping me set up my MetaMask and showing me how to do a Uniswap trade. And it was like, and I was already deep into crypto, but DeFi was just starting to emerge. And it was like, you know, getting familiar with how to do all of that. There's a big learning curve. And then people have looked around and very, you know, and like justifiably been afraid, like, I have a personal friend, in fact, one of the friend that showed me how to use this, used MetaMask for the first time, got exploited and lost a massive amount of money over the course of an hour, and there's no recourse, right? So people can be afraid to use this. So it's like, okay, BlockFi is really simple UI, and I don't have to, you know, worry about some exploiter taking all of my money. But on the other hand, DeFi brings these other major advantages, and in certain ways is much lower risk. And so lower risk in a few ways. One, the centralized counterparty can become a problem, as we've seen. You know, if they lose a bunch of money, and then they have to lock up user assets, and okay, that's as good as if an exploiter took your money. Maybe, okay, not quite as bad, but you know, in the ballpark. And then BlockFi also has less attractive terms in multiple ways. So they charge high interest, and then they also their loan to value is more conservative than Liquity, right? So at a given price of ETH, you're more likely to be liquidated there. You know, or a given loan to value, you know, hey, I have 1,000 ETH and I borrowed X amount of money, I'm going to get liquidated at a higher ETH price there than on Liquity. So there are kind of advantages and disadvantages in both. And so I think some of our clients that were wanting to do this through BlockFi are just like, I don't want to be doing this myself. I don't know how to do it, and I'm afraid to do it. And that and so we're like, well, we can do it for you. We have the DeFi expertise. We have all of the security systems in place to not, you know, get exploited and lose your private key and lose your funds. And we're heavy DeFi users, so we can do it for you. I'm a big advocate of people learning how to do this themselves as well. But admittedly, I think UX and wallet, that kind of stuff it's a real thing that we need to improve as an industry. So with this first client that we ended up doing this for, that person had a large amount of ETH, and they were buying a home and wanted to borrow against their ETH rather than selling. They were getting ready to send to BlockFi. So we talked them through, okay, BlockFi is going to charge you more. The risks are worse in like, okay, you'll get liquidated at a higher ETH price, etc. So let's do it here. It was such an easy conversation. It was literally like a 5-minute call or less to get them on board, because the advantages are so stark. The amount of saved interest payments is pretty crazy. So then we came in, we minted some LUSD against their ETH, converted to USDC, and shot that over to their to them. They converted, bought their home. And then what's interesting is the aftermath of that is a really good example of why this is so advantageous. That transaction happened before the 3AC meltdown. And the 3AC meltdown happened, and ETH price, you know, nuked. And we were on the phone talking with that client about, okay, here's where your liquidation level is, et cetera. And talking to them about how to risk manage, like, okay, you know, if you want to get your liquidation price down, you know, send us some more assets over. At one point, they sent some stablecoins over, and we paid down the debt a little bit. And then at another point, sent some ETH over and added to the collateral. And we looked at it, that person would have lost their entire, basically almost their entire net worth, but all of their ETH if they had stayed in BlockFi. because one, it takes a little bit longer on those centralized exchanges to get assets in the door. You send them ETH, and then it has to, spend some time clearing their system, and then you can add it to your collateral. So that's issue number one. But issue number two, the meltdown 6 months ago was so severe that they would have blown right through their liquidation price and lost everything on BlockFi. Well, there was a lot of nervousness for the Liquity loan, because it was like, how far is this going to drop? Like, I don't know, I have the numbers right off the top of my head because we're like talking about it as it's happening. But when ETH just dipped down to below 900, their liquidation price was well below that, but it just kind of felt like this free fall. How far will it go? But they avoided liquidation. And so the delta here for that particular client is, okay, we saved them 6 figures of interest payments a year, plus their entire ETH stack. Because, like I said, they would have been liquidated on BlockFi. So that's like a good example of just how attractive it can be. So exact same assets, exact same borrow, etc., you're going to be liquidated a lot faster in some of these other places because their loan to value is so much less attractive. So I think you asked a series of questions, and I probably answered less than half of them. Remind me what else you wanted me to touch on.
No, I think you covered that very well. So, and one additional question would be, from the customer's perspective, what are their questions? If you kind of suggest Liquity, what is kind of their biggest concern or question to you?
There's always questions about the risks of the platform. So clients are aware that some DeFi platforms have been exploited, et cetera. So, okay, what do the risks look like? Have they been audited? What, like give us a sense of the risk of the platform. How long has it been around, et cetera? So that's question number one. Question number two is, obviously, what are the parameters? How much am I going to pay, et cetera? Are there any hidden, like lurking, things there? Hidden costs, et cetera. And then the last question is, is it big enough to facilitate me, right? So, if I have a client that wants to borrow $5 million against $10 million of ETH, just as an example, there may be a high quality alternative that just won't be able to facilitate that because they don't have enough liquidity on Curve and things like that. So that's a third question. And then some of the questions also get into the comparison. So like if you're to compare Liquity to the alternatives, and I think there's a lot of high quality alternatives here. So, in that very first client call we had, I walked them through several alternatives. Like, okay, here's what Aave would look like and the advantages of Aave. Okay, it's a variable interest rate that can change based on supply and demand. So you can't guarantee that that it's going to stay this low, but it's low. Okay, that's great. You can pull out at any time, et cetera. Okay, here's what Liquity looks like. For a longer term loan, that's even more attractive cost wise. And then, here's what the allowed loan to value is, et cetera. And then like we looked at Alchemix. Okay, with Alchemix, you don't have liquidation risk. The most you can borrow is a 50% loan to value. So if a person's trying to borrow 60, then they can't. But if it's below 50, great. And then your risk profile is pretty different there. It's, it's collateral lockup, duration risk, where, okay, if the self-repaying loans repay very slowly, are you okay with that opportunity cost? And then also, are there vaults open? Sometimes they can't facilitate you. So so Liquity is best in class in a few of those regards. Obviously, high quality audits. It's been around for a while without an exploit. So check. And then it's immutable, and that's a big check. Like I said, I referenced this earlier, but I had a call yesterday with a they're a crypto native treasury looking to get some stablecoin management, and they were asking us about our due diligence, and they're like, and their thing was like, well, hey, if you due diligence this project and then they change the code, they push some change to their code tomorrow, then your due diligence is maybe invalid or whatever. And my response was that, like, yeah, the immutability is a superpower, right? And we play in places that aren't immutable as well, but that like really reduces the risk in a lot of ways, where you look at the history of exploits and the audits and the mechanisms, and if all of those risks are like look really solid, you can also be sure that it's not going to change. So those are a lot of the things that will that clients are interested to know about, and that we'll talk them through. Some clients are more want more in depth than others. Some there's a high degree of trust we have with our clients, and so like one of the clients that we did this for, that we basically pulled them out of BlockFi. They already had a BlockFi loan, and we basically pulled them into a Liquity loan. It was like a less than a 5-minute conversation where it was like, here's the costs on BlockFi, here's the costs here, or in a few of these places, and for you, we think Liquity looks really attractive. Here's a high-level summary of their mechanisms and why we think that it's like a really like resilient protocol. Done. So and honestly, those conversations have been so easy. Like I haven't had pushback hardly anywhere, and those conversations were easy before a lot of the centralized crypto entities started melting down. And since they have, I think people are much more on board with holy crap, maybe I don't want my money on this platform that will lock my assets. And so it's become even easier. And so then it's just about, okay, within DeFi, how are you vetting these? And I think in several of the regards, Liquity is best in class, like immutability especially. And then in efficiency and things, and in some regards, like say MakerDAO is best in class. Like if someone was needing to do something crazy and borrow $100 million, okay, you're going to have to go to MakerDAO probably, or Aave for that.
Sure, and that reminds me of a story you also told about a customer. Maybe it was the one that you just had the 5-minute pitch. But which I thought is interesting, and never thought it in that way, because you said there was a customer, and I think the only question he had is kind of, how is it possible that I pay only a 0.5 one-off fee? So maybe you can tell something on that and how you answered that question.
Yeah, good question. And that is something that I'll hear from some people, as it sounds too good to be true. I especially hear it from crypto skeptics of like, especially if you talk about both at the same time, like, hey, you can earn high yields on stables and you can borrow stables at zero. They're like, how is there a delta there? Like that sounds like something weird. So the way we've spoken about that is like, okay, if you deploy an immutable system, so you have no dev time ever again, the Liquity team has no ongoing costs with Liquity, because you're not making upgrades to the software, and you're super efficient with your mechanisms. It allows you to drive the cost to near zero. And Liquity is an interesting example of that. Like, okay, I don't have the numbers right off the top of my head, but roughly $30 million of revenues it's generated is what I'm remembering since its inception, with no ongoing costs and really efficient mechanisms. It can be really profitable, and the fact that the cost of maintenance and those things is zero means that you don't really need to generate hardly any revenue for the platform to stay solvent and to make sense for those who built and deployed it, etc. So it's really that immutability and the efficiency that we tend to talk about there. If you build a system that requires thousands of devs with constant upkeep, you're going to have to pay for those devs, right? And if you have to have a whole risk management team because you're doing things more dynamically with asset collateral types, et cetera, you're gonna have to pay for those. So if you can get rid of all of those because you're immutable, you're taking just ETH collateral, et cetera, that's the way that we talk about that piece. And I think people can understand that pretty quickly.
Yeah, I find it just so interesting, you know, kind of that people kind of the question that they need to answer to trust the system was more kind of how is it possible that they don't have interest, you know? So I find that interesting. And yeah, I mean, also for the listeners, I mean, how does it work? I mean, Liquity has been working the protocol on its own more than 1.5 years autonomously, and in this time issued the 4 billion in loans and managed on its own. Yeah, and us actually watching from the sideline. So I think just that you get a dimension or an idea how that works. Just a last quick question on that use case. How do you think things will change now with the raising interest rates, especially in the US?
That's a good question. Yeah, so there's a number of dimensions to that. So borrowing against your assets on a place like Liquity becomes even more attractive, right? The delta is really high. So for someone who has collateral, borrowing here versus getting a traditional mortgage to buy a home, for example, is extra attractive. So from that angle, I think it becomes more compelling than ever. There is another angle that's interesting, though, where we are, like I said, we're managing stablecoin for yield for a number of clients, and that angle is the reverse to some extent, where, you know, if you are saying, hey, I can earn 5%, you know, a year ago that was like, wow, 5%, I can't get much, I can't get hardly anything in traditional markets. Okay. But now someone who's working with us says, well, you know, you need to justify why I'm not just sitting in treasury bonds. And that's been an interesting thing, because during the height of the bull market, yields were really high and TradFi yields were nothing. And now yields are harder to find than they were back then, and TradFi yields are coming up. And so it's becoming less of a slam dunk in some cases. And so, you know, we're still earning better yield than you can get in TradFi given similar risks. But the bigger the delta, the easier the conversation, right? So in that regard, I think at a high level, you know, maybe flows into crypto, institutional flows into crypto, slow down for some period of time, because there's finally some better options in just buying bonds or whatever. So, you know, we haven't had clients turn away from us, but we have had clients who said, hey, you know, we have a target range of yields, and before they were like, we're super comfortable with you being at the low end of the range, and often we were above the range, honestly, but like, you know, it's like, hey, do the safest of the safest. We don't care if you're at the low end of the range. And then the conversation has shifted where they're like, well, we really need you to be at the higher end of the range to justify the relationship. So that whole piece has inverted. And I think we'll probably see that cycle back and forth for a long period of time, and as DeFi matures. Eventually, I think that they need to come in parity relative to their risks. And as DeFi protocols prove just how robust and resilient and low risk they are as far as counterparty risk, et cetera, the natural state of things in a decade, 2 decades, is probably that DeFi yields are lower than TradFi yields because they're lower risk. And then that would be like a natural thing, but it'll be the reverse for, you know, as the industry matures.
Okay, cool, great. So actually I wanted to go to the next use case, but I see there was a question from the audience. What's a risk or kind of liquidity or a downside, or what do you need to be aware if you borrow with Liquity? I think we have seen a lot of great things, and kind of to be transparent and fair, everything has pros and cons.
Yeah.
Maybe you can say something on that.
Yeah, good question. So a few of the risks that I think are important to be aware of is one, you can get liquidated, and liquidations are complete. You lose all of your collateral. So that's, if you're borrowing a lot against your ETH and then we're living in volatile conditions like this, that can be really scary. So, and actually, this is a conversation we've had with some clients is, hey, probably a good idea to pay loans down. Like volatile crypto assets are probably not things that you want to be borrowing high amounts of money against, generally speaking. So that's piece number one, is just, should you be borrowing against this asset in the first place? And there's some risks there. And if you are going to do it, my suggestion is do it at an incredibly safe loan to value, very low loan to value. Be massively over collateralized. So that's a suggestion I would have. Like, and we've seen this where people borrowed at what felt very safe and wasn't. At the height of the bull market, if you borrowed 50% loan to value, that feels like, man, I have a giant buffer, and then you would have been blown up, right? If you just held the position, because ETH's down way more than half what it was at the peak, right? So that's piece number one. It's just, should you be borrowing against this asset in general? That's not Liquity specific though. And then the two others that I kind of would touch on, or three, I guess. If you are at the kind of front of the queue, you have this risk of getting redeemed against, which is that's painful. It reduces your ETH exposure, and the whole reason you borrowed in the first place probably was to get some money without reducing your ETH exposure. Otherwise, you would have just sold ETH to buy the house. That's another reason to not be super risky with your loan. You want to reduce the risk that you're the person to get redeemed against. So that's number two. And then two others. If you are a person who may enter the loan and then exit it pretty quickly, it's not quite as attractive. You do this upfront mint fee of 0.5%. Well, that's pretty attractive borrow cost if you're sitting on a loan for a year, 2 years, 3 years. The longer, the better, because your ongoing interest rate's zero. But if you enter the position and then you change your mind and you want to pull out of it in a week, annualized, that's a pretty painful borrow cost. So that's another risk here is how long do you expect to be in this position? And then the last one is LUSD does a really good job of holding its keeping from depegging to the downside, but it often goes over peg, and that feels nice when you're minting. Hey, I minted, it's 5 cents over peg, I swapped to USDC, I got 5% positive slippage. Great. It can be painful if you're needing to repay. And that is one thing that the UC can be kind of nice about systems that sometimes will depeg, is it is free debt forgiveness. And we saw that this week in Abracadabra. MIM started to depeg. It dropped maybe to, I think it was like 96-ish cents. And if you were in their Discord, a bunch of people were like, oh, great, I'm going to go repay my loans and get free debt forgiveness. LUSD basically never depegs to the downside, so you don't get to repay your loans at a discount. You don't get that nice benefit. And sometimes it depegs to the upside. And so, yeah, if it's really volatile conditions and you're like, shoot, I need to repay this loan and I don't want to get liquidated, and LUSD went from $1.02 to $1.05, that's like an implicit borrow cost that you're bearing, essentially. And that's something to factor into the equation. You say, okay, I'm going to pay 0% ongoing forever, but I could pay 3% because I have to buy LUSD at a premium.
Yeah, I mean, fair point. So for users that are not aware, LUSD has pretty good and hard pegs to the downside at 1 and at 110 on the higher level. And usually, as Rhett said, it can depeg upwards. We've seen it 103, 104, 05 at this range. And then there are soft forces pushing it down again. Yeah, I think that's definitely something to be aware of. Right now, it's around 104, which is on the higher side. As you said, if you open now alone, you get kind of free debt. But of course, if you need to repay, something to factor in. And I think it's also because the system is immutable and running on its own. So it's not that the Liquity team could do something or now steer something. So it's also, sometimes we call it a premium of resilience. And why is the price so high? Because LUSD is in demand. People want to have it, but the system can't just mint LUSD. It needs to be backed. And in a bear market, there is not so much borrow demand. So it's not nice, but it's something inherent in the system and someone that values the immutability and decentralization. That's right now with today's system designs a bit the downside, which you need to be aware of. There are other systems which hold the peg much more in a better way, but where kind of you have other risk because it's not immutable, because the collateral is lent out to a centralized player, all these kind of things.
That resiliency premium is a really good way to put that. I really like that. And yeah, it's a downside, but for a lot of people, something that you may be willing to bear. And it's interesting. Normally, an overpeg is an implicit incentive to borrow, and underpeg is an implicit incentive to repay. But you don't have the underpeg as much. And then there are things like Abracadabra, when they were depegging to the downside, they just came in and said, hey, we're increasing our interest on these different collateral types to encourage you to repay. And then you can do the opposite. If they were going over peg, they could come and say, we're reducing interest on all of these to incentivize people to borrow. You can't do that, but you get these other really powerful benefits of being immutable. That tendency to go over peg can be an attractive thing to someone on the other side of the aisle, someone who's not wanting to borrow against their LUSD, but just wanting to earn yield on it, right? So if you're a borrower on a platform like Liquity, you don't really care that much about a depeg. It's free debt forgiveness. Like you can, if Liquity depegged to 50 cents and I had an open loan, wow, that's incredible debt forgiveness for me. I can just go and repay, and great. You care about depegs a lot if you're a person who's holding that stablecoin and earning yield on it. That's the person who really benefits from the fact that it never depegs, or it doesn't tend to depeg to the downside, and can accrue a premium. So if you bought LUSD at $1 and you're earning yield on it, and then it pumps to $1.05, your true yield was higher than the yield you were earning. Say, okay, you threw it in B protocol and you're getting X%, but then the price of LUSD pumped to $1.05. You can realize that gain by selling out of the position, or it's just kind of baked in there. So the depeg upwards is it's implicit borrow cost to someone who's trying to repay a loan, but it's also like implicit yield to someone who's holding that asset and trying to generate stablecoin yield on it.
Sure. Cool. So let's also touch on, at least on the second use case. But I think, so you mentioned the dollar cost averaging, into ETH, which I think is a really interesting use case. Not a lot of people are aware of in Liquity, because Liquity, usually people go to Liquity to borrow, as you said. They give their ETH as a collateral, take out this margin loan in LUSD. So that's one use case, the borrowing use case. Out of that, people put LUSD, the stablecoin, into circulation. And now there is another part in the system called the stability pool, and it's part of the liquidation of these margin loans, and that's part of the efficiency you mentioned. Liquity has this instant liquidation that allows the protocol to have this high loan to value ratio. So there is capital in the protocol. If there is a margin call, is instantly liquidated, but people have to provide this liquidity, and that's what we call the stability pool. People put the LUSD into this stability pool, and they earn some yield on it. One, the protocol is incentivizing it with its own token, and with the token, the depositors get access to the protocol revenue, which the protocol manages on its own. And the other thing, because the debt is repaid with the LUSD, they get ETH in exchange for their LUSD, and because it's liquidated usually at a discount of up to 10%, more or less. So that's just the mechanism so for our users to understand that. And now, can you put that into perspective, how this becomes a dollar cost averaging strategy to get into ETH?
Yeah, absolutely. So we've, during the market meltdowns, the 3AC meltdown especially, but we're, it's happening kind of again right now. A common question we get from some of our wealth clients is, that are sitting on stablecoins is like, hey, I would love to start buying this dip, but there's always uncertainty, like, are we near the bottom, et cetera. And so, so many of them, rather than just coming in and market buying ETH, will want to kind of, edge into it over the next few months. And so a lot of those conversations came up, like I said, during the 3AC meltdown. The dumb way to do this, not dumb, but like, the way a person might think to do this is like, okay, I have $100,000 of stable coins. I'll just buy 10K on Uniswap of ETH today, and then I'll come back in a week and do the same, and so on. And then you can make it, slightly more attractive if you do other kind of enhancements. But it's like, okay, if I'm just going to sit on USDC and then buy 10K a week, if instead I throw that entire amount into the Liquity stability pool, okay, number one, I'm earning yield while I'm sitting on it. And it doesn't require any active management. It's a very simple deposit and kind of forget about it, essentially. So I'm earning yield while I'm sitting on it. And then, when someone's liquidated, not only people are liquidated when ETH price dumps. So not only are you buying the dip, but you're buying the dip at a 10% discount to the dip, right? And so, ETH dumps to 1,000. And you're a person who's like, whoa, ETH dumped to 1,000, I want to buy some. Well, if someone got liquidated at that point, then it's like you actually bought it at 900, right? Which is really nice. So it's like this. It's like a triple benefit. Now, like I said, the downside to it, and I wouldn't even call it a downside, but the only level of active management is, say I had 100,000 USDC, and I wanted to buy 10K worth of ETH a week until I'm out. You can't guarantee that you'll be buying the full 10K a week. If no liquidations happen, you bought nothing. And then if a massive liquidation happens, something insane, then maybe you bought more than that. I think most people don't care as much, like, okay, I DCA'd in a little bit faster, but I did it at a discount and I got paid LQTY, great. But if you want to guarantee you're getting some ETH exposure and not just sitting in a pool and you don't end up DCAing. So in a worst case scenario, if you threw into the stability pool and forgot about it, and then no one got liquidated, and a year later, you didn't have any of that ETH you were trying to DCA into. So that's the only level of management here where a pretty obvious enhancement to the just buying 10K a week is throw all of it in the stability pool and then pull 10K a week out to buy ETH until you're fully deployed, if you're looking to DCA.
Cool. Yeah, that's an interesting one with kind of, pulling it out. I think that's a nice addition to the just letting it sit there. Cool. So we are almost up. Just looking if there are other questions. But is there anything kind of we didn't touch on you want to touch on? I mean, we didn't look into in the yield cases, but or is there another aspect you want to highlight or talk about?
Yeah, good question. I touched on most of the ways that we're currently using the system, and I personally think there are a number of really high quality DeFi protocols if you want to be a borrower or generate yield, etc. But Liquity is a very attractive option for many people. Like the risk profile for many users is about as good as it gets, and so it's been a common place for us to play. So really, like, a lot of congratulations to the Liquity team for building something that's so high quality and is meeting certain risk criteria in a way that nobody else is. You know, if you say, hey, what's a protocol that doesn't have like really any censorship risk because it doesn't have, say, USDC collateral under the hood, you're getting thin. If you just have that one kind of parameter, you're getting thin really quickly. And then, okay, that also holds peg really well, that also has a reasonable amount of liquidity, that's also, you know, immutable, can't add collateral types. It's really the only one. So there's a lot of really great things about Liquity, that it's really the only one doing some of those things in a way that's scaled up enough for people to be able to use it. In fact, some of those things, it's the only one I'm aware of that it's doing that. So anything else that exists is small enough I haven't heard of them yet. And I spend all day every day in DeFi, so there's, you know, nothing of reasonable size I haven't heard of really. So that's those are all really great things. And I think there's this thing I'm trying to educate people on, and which is just that in many ways, DeFi is already far superior to CeFi. So if you're wanting to do things through like with crypto assets, through centralized entities, you should ask yourself, why am I doing it there rather than in a place like Liquity? And, you know, for future builders, I also think that, you know, the BlockFi killer is going to be something that just plugs into a system like Liquity or DeFi in the back end. And then it's just, oh, okay, you're just a user-friendly UI and you do some marketing and, you know, you custody assets effectively. You have, you know, a good solution there. And then you're just plugging into these things and passing through all of those, you know, efficiencies to the user. I think, you know, that's kind of the BlockFi killer of the future, I feel like. Just to, you know, not just BlockFi.
CeFi in the front end and DeFi as a new backend, you know, as what it is a new financial backend. And it's nice that you're looking a bit in the future at the end, and we're almost at the end with time. So my last question is also a bit an outlook. Where do you think kind of will we be with DeFi in 2023, you know, the end? What's the big thing you think will happen, will evolve next year?
Oh man, within the next year. Good question. I think we're going to have, yeah, I mean, this is actually on a completely different topic, but I think as L2s are maturing, for example, and other scaling things are improving, I personally think that it unlocks a lot of DeFi things that were harder to do before, and we're already starting to see some of that. So I think we start seeing a lot more maturing of like derivatives exchanges. That's a completely different topic than this, but a lot of those things were really infeasible at layer 1, and you're seeing derivatives exchanges getting a lot of usage at layer 2, and in some of the more scalable blockchains. So that's a segment of DeFi I see maturing a lot over the next year. Over the next 5 or 10, I see a lot of like maturing risk, like for the big blue chip, like perceived risk coming down, because there's already lower risk for a lot of these, and then also true risk coming down. And so then I see like more inflows and more kind of DeFi mullets, like, you know, centralized front end, DeFi on the back end. I see that becoming much more of a thing. But that'll take probably more than a year. Like, I think that's something that you see over time, where this becomes the infrastructure for all the major traditional financial institutions.
Cool.
That's like a decade-long thing.
Yeah. Hey, that was amazing. I'm so thankful you came up and did this session with us to hear the client stories, especially, and how you use it at Wave Financials. Where can users, listeners find you, or also Wave Financial if they want to learn more?
Yeah, sure. I'm on Twitter, and my handle is my name, Rhett Shipp, RHETTSHIPP. Wave also has Twitter, Wave_financial. And on the Twitter, you can find the website, etc.
Cool. And I'm
really glad to be a big fan of Liquity, and we've loved using your platform.
Thanks, and we loved hearing your feedback. And we'll link all the details in the YouTube, so there will be a recording, so you'll find also all the links there. Thanks a lot. It was amazing talking to you.
Yeah, same. Would love to talk again. Thanks so much.